So I want to explain how do you access life insurance money. Again, I am Michael, just in case you don't know me. Um, Life insurance is to me it's the biggest investment because you put in less money and you get a lot of money. You know, be it a term life, be it a whole life, be it a universal life. You invest very little money, and if in case of anything, you get a lot of money. But now I want us to explore how we can get money from life insurance. How do you access money from life insurance? There are certain ways of accessing money from a life insurance policy. But before I go to that, I want to explain that you need to have a life insurance policy simply because it's part of of building a financial foundation. Okay, it's part of building a financial foundation. And when you're building a financial foundation, what you're looking for is proper protection. Okay, you must have a proper protection. You must have a debt management system. You must have an emergency fund. You must have investments. So when we are talking about accessing money, when we talk about insurance, we are talking about proper protection. But guess what? You can actually use this some of these policies to get the two. In fact, you can sometimes use the same account to build the whole financial foundation. But in order for you to understand that, sometimes you need to attend a lot of workshops to understand how these accounts work. But in any case, when we talk about proper protection, we are talking about auto insurance. We are talking about health insurance. We are talking about property insurance. We are talking about um, life insurance. We are talking about travel. We are talking about all that insurance that you buy for your jewelry forever. That's proper protection. What if something happens to that, whatever you bought? What if I want to travel and I, I somehow change my mind and I don't want to travel? Instead of losing a lot of money, like, why don't I just lose a few dollars if in case I travel? So in other words, when you're buying insurance, you're extending a risk. It doesn't mean that the risk is going to happen, but you're extending that risk to somebody else. And in this case, that somebody else is what? Is the company. Okay. And of course, when it comes to life insurance, it's the only insurance, which you will use 100%. You are 100% sure that you will use life insurance. You are 100% sure that you will use life insurance. And that's why it's very powerful. Can I get sick? Yes. But guess what? I can spend years without getting sick. So I might even die without going to the hospital to use this. Property, I might sell off my property without ever utilizing this. Auto insurance, I can drive so many cars and I don't get into an accident. for 20 years, 30 years. So I might not have to use auto insurance. Now, that's why life insurance is the only type of insurance that you are 100% sure that you will use it. So now, again, when we talk about life insurance, we are talking about why am I 100% sure that I will use it? Because I'm 100% sure that I will die at a certain point. If I don't die, I get sick, I use it. So that's why it's very important to have it. Again, what differentiates the different types of insurance is what we call the cost of insurance. The cost of insurance increases as you grow. So in other words, you cost high when you grow. So you every year, you become more riskier to the company. That's why the cost of protecting you becomes higher than it was the previous year. So that's why when you buy a term life, for example, a term life insurance, they are looking at you from wherever you started. Let's say you are X years old, up to whatever you're buying. If let's say you're buying a 20-year term, that means at the time when you are X plus 20 years, that's what they are looking at. So in other words, they are charging you from here to here. So because they are charging you from here to here, then that means you're only going to pay this, this much. That's why you can pay only $50 to get $1 million. Okay? But if you have so this is a term. This is a term. And what is it? It's short-lived. It just protects you for a short while. It's limited. Okay? To 5 years, 10 years, 20 years, 30 years. You don't die within that period, bye. You don't owe us anything. You die within that period, so sorry, the company is going to pay. Now, when it comes to whole life, what happens is they are looking at your age today and your age forever, whenever you will die. So this means they are looking at a very wide scope. So that's why they will take a bigger number. So that's where you find that the same person, same age, same everything, but a person with a term life pays way little, way less than the whole life. So let's say this person pays $50 and this one pays $500 to get the same policy, same kind of policy, same everything. Now, characteristics of a whole life, it's permanent, okay? Permanent, meaning it will protect you until you die. Level death benefit, meaning whatever you apply for is what you have forever. Level premium, meaning whatever they tell you to pay is what you're going to pay forever. Okay? And it's permanent. It's going to protect you until you die. Now, what happens is you realize that if you had gotten a term life, you would probably pay $50. But here you're paying $500, meaning there is some money that you paid here that you shouldn't have paid in the first place. So you're paying this money to the company, and this is what we call the cash value. So you're paying this cash value. Whenever you pay the 500, they take off the cost of insurance, and then the rest of the money is what we call the cash value. Now, for the whole life, the company is going to give you like 2 to 3%. Okay. And now, what do I have? What if I want a more flexible death benefit or adjustable death benefit and a flexible premium? So this cash value now, I'll have what we call universal life. Universal life. So universal means it's also permanent, but instead of a level death benefit, this is going to be adjustable. Adjustable death benefit. And then you also have flexible premium. Flexible premium. But guess what? If you have flexible premium, adjustable life insurance, adjustable death benefit, this company, the company gives you around 3 to 4% in a universal life. Until now, when we have a variable universal life, we have a variable universal life, variable, but a universal life, meaning it has adjustable death benefit and flexible premium. But what happens is they get this cash value and put it in a separate account where it grows according to the market. And if the market goes down, your money goes down. If the market goes up, your money goes up. And then we have the index universal life. Index unit, it's a universal life, meaning the premiums are flexible. Okay, flexible premium, and then adjustable death benefit. But guess what? This money grows and it can grow up to a certain cap. But when the market goes down, you don't lose money. There is what we call a flow. So this has a cap, sometimes uncapped, depending, and then it also has a flow. So meaning if you have money in this account, you don't lose money. If you have money here, you lose money. So, but my main topic today, why am I going through this, is to show you the different types of insurance. So by the time I talk about the index universal life, you have an idea of what I'm talking about. Now, how do you access this money? First of all, what happens when you get a policy? what happens? Um, when you get a policy, this is what happens. Okay. This is what happens. You pay a premium to your policy, okay? Whatever they tell you to pay. Again, this depends on your age. So what are the factors? Factors, age, sex, health, social life. These are what this is what is used to determine how much you pay. Okay? So they will tell you, okay, let's say you are a female, 30 years old or 36 years old, and you want 300,000. So female, 36 years old, wants 300,000, and they'll tell you, you know, pay $200 per month. So you pay $200 per month, which makes it 2,400 per year. Okay. When you pay this money, remember this. When you pay this money, the 200, part of the money goes into the cost of insurance, and then the rest of the money, in this case, in the index universal life case, money grows according to what we call an index. What is an index? An index is a combination of different stocks tracked together. For example, the S&P 500, NASDAQ, etc. These are indices. They are stocks tracked together. So now, when they determine that you're going to pay $200, and I've told you part of that money will go into the cost of insurance, and then the rest of the money will grow. So this money now grows according to the index market. Meaning, if the market makes 10%, they're going to give you 10%. If the market makes 5%, they'll give you 5%. That means you have money, you've paid money in this account. Next step, a portion of your premium will go towards policy fees and charges. Here. A portion will go here. Policy fees and charges. And then, number 3, the remaining amount or net premium can be allocated across a variety of index accounts. I gave you an example of index accounts like the S&P 500, the NASDAQ, the Eurex, stock exchange, the Eurex, you know, all those are indices or indexes. So the remaining amount of whatever you pay is allocated across a variety of index accounts. What happens then? The net premiums allocated to the index accounts or basic account have the potential to build the policy's cash value in a tax-deferred way. Okay? And this can be used to provide a federal income tax-free death benefit, access to tax-free income, tax-efficient policy value accumulation. Now, this brings me to our topic today. How do you access money from a life insurance policy? There are certain ways of accessing money from a life insurance policy. Depends on where you are in your life. So you can access money, you can withdraw some money, or you can take out a loan. And this is when you're still alive. Then you can access money if you get a terminal illness, if you get a critical illness, if you get a long-term illness. This is if you're ill. You can access money from your life insurance. If you are ill, you can access money from your life insurance if you are still alive. And you can access money if you can access what we call the death benefit. Death benefit. And this is if you are dead. 3 ways to access money from a life insurance policy. 3 ways you can access money from a life insurance policy. Okay? Number 1, withdraw. How do I withdraw money from a life insurance account? Now, when you pay your money into this account, into a life insurance policy, when you pay your money, I want to remind you that part of it is going to the cost of insurance, and the rest of it, which is growing, which is the cash value, grows according to the market. And that is what you can access. You can actually withdraw that money from that account. How? I'll show you. Where's my withdraw thing? Okay. I have my withdraw paper that I wanted to show you. Now it gets there. But this is what I want to show you. If I have this person who is saving $200 every month. Okay. They're saving $200 every month. That's the regular premium. Regular premium 200. Okay. And because this account is growing, they can actually they pay. You remember I talked about the cost of insurance? So here, charge deduction. What is this? 66.42. That's the cost that they are paying to get this policy. They also pay $6 as an index account charge. And the rest of the money, so this is what is deducted from the $200 this person is paying, and the rest of the money grows according to the market. As you can tell, in this month, this person made $96. In this month, this person made $105. So what this means is if we consider this, so sorry. So since he's paying $200, that means a year he pays 2,400. Okay, 2,400. Now, when he pays 2,400, what happens? Part of that money grows, and if something happens to them, then they have the 300,000 they applied plus 1,400 that they have in their policy value. Because this is money, this is their money that is growing. That's why they get it when they die. At this point, when they surrender the policy, they don't get anything. If they want any money, they can't get anything. They can't access money at this point. In year two, they have 2,900, okay? And they can't access any money, but if something happened to them, they have 312,000. In year four, they have 6,000. They can access up to 652. In year, let's say 15, okay? Year 15, this is how much they've saved so far. This is how much they've paid, 36,000. If something happens to them, their family has 300,000. How much have they paid? 36,000. But part of the money is growing in their index account. And by that time, they have up to 32,000 that they can actually access as a withdrawal or a loan. This column is what you get when you surrender the policy, but it also reflects how much, like the maximum you can take out in that account at that point. So what happens now is if the person wants to withdraw money from their account, can they withdraw? The answer is yes. They can withdraw some money if they want money. If they want, I'm looking for my withdrawal paper, but I don't know who took it. So if you look at their account now, this is their account now. Okay. They have long-term care. They have 300,000. They have long-term care, which is 6,000 per month. They have critical illness. In case of a critical illness, they can access up to 270,000. Okay. And what happens in case they want to withdraw some money from their account? Since they already have, where's my withdrawal thing? Anyway, since they already have some money in their account, in this account, they can, let's say at age 15, they can withdraw up to this much. Maybe they want $5,000, they withdraw. But what happens is they have to withdraw uh, at least $500. You can't withdraw less than $500. Okay, if you decide to withdraw, you have to withdraw at least $500. If not, don't withdraw. You can't say, I want to withdraw $200 from my account. No. If you want to withdraw, you withdraw more money. 500 plus. Okay? Now, what happens when you withdraw? When you withdraw this money, it's obviously the cash value goes down because you've taken part of the money. The cash value will go down. And automatically the death benefit will also go down. Because let's say here, you have 32,000 here and you take out 10,000. So instead of 332,000, then you have 322,000 because you've withdrawn 10,000 from here. Okay? So that's how you can withdraw money. I wanted to read for you something, but I can't find it. I don't know where I put it. But anyway, I can still show you something here. Withdraw. So guess what? Whatever you're withdrawing from this account is actually tax-free. This is tax-free. So you will enjoy easy access to your policy value. You may request withdrawals after the first policy anniversary and loans after the free look period, provided the policy value is sufficient. What is the policy value? As long as you have enough money here to beat the, to deduct off the surrender charge, then you can access money here. That's what they are saying. Think of the possibilities. You could use the funds to supplement your retirement income. You can help pay for your children's education or unexpected expenses. So you have tax-free withdrawals. How do you access this account, this money? You can withdraw. Number two, you can take a loan. What happens when you take a loan? Again, let's still use the same row. Let's say this person is 51. They have 32,000 in their cash value. They have 32,000 in the surrender value. But if they die, they have the 300,000 plus the 32,000, which makes it 332,000. But let's say they need some 10,000 to do whatever they want. So what is going to happen? They'll simply write to the company and say, hey, I need 10,000 from my account. So now they're taking a loan. What happens when they take a loan? How loans work? After the free look period, you have the flexibility to take tax-free loans at any given time, up to the maximum allowed by the policy. The policy loan interest rates on the on the account are generally lower than loan rates charged by banks. An amount equal to the policy loan will be credited with a minimum guaranteed annual interest rate of 2%. An annual interest rate will be charged as follows. Between the years 1 to 10, they will credit you 2% and charge you 2.75. So the net effective charge is what? 0.75. That's the current rate. But they promise that they will never go above 1%. Currently, 0.75%. From years 11 plus, you're credited 2%. You charged 2%. So the net effective charge is what? 0. In other words, if you take a loan from this account after year 11, how much do you pay interest on your loan? 0. 0. Why? What happens is when you take out a loan, an equal amount is put aside, and that is what is credited. Okay? An equal amount of whatever you've taken is put into what we call a loan reserve. And this loan reserve is what is credited by the 2% that they are talking about here. Credit 2%. They credit the loan reserve. By the way, I am showing you Transamerica, but it's not the only company that we represent that does that. I want to show you another company that does the same thing. Because when you understand that this is something that has been in existence for some good time, then it makes more sense to you. So you may request a loan. The loan date will be the date we process the loan request. The loan will be secured by that portion of the policy value equal to the amount of the loan. Any loan balance will be deducted from a certain amount payable by us under this policy. When a loan is made, an amount equal to the loan will be transferred from the account options to the loan reserve. The amount of the loan will first be transferred from the basic interest account to the extent of its value, and then transferred on a pro rata basis according to the policy value from each index account. Under each account option, the amount will be transferred pro rata across segments. We'll credit the amount in the loan reserve with interest at an effective annual interest rate equal to the loan reserve interest rate credited, shown in the policy data. After the 10th policy anniversary, certain loans will be classified as preferred loans, and the interest rate that we charge on preferred loans may vary from the interest rate charged on other loans as outlined in the interest loan below. The policy value minus total premiums paid plus withdrawals minus the loan balance is the amount eligible for preferred loan. The minimum amount you can take out as a loan is still $500. Maximum is you may borrow the policy value as of the date of the loan request minus an existing loan balance, interest on the loan balance including the new loan, and the amount of the surrender charge that would apply on a surrender of the policy or 2 monthly deductions, whichever is greater. So, and how do you pay back the loan? You may repay any part of any loan balance at any time while this policy is in force. Okay? You may pay any time. If you wish to make a loan repayment, you must tell us that the payment you send us is for that purpose. Unless your payment is clearly marked as a loan repayment, we will assume it's a premium payment unless it's received after the insured is age 121. So loan payments, repayments will reduce the loan reserve and will be applied to the account options in accordance with your current premium allocation instructions. So that's why it's very, very important to understand how you can utilize these accounts to build cash, build wealth. This is a different account. This is a different company. Okay. And what does it say? It says, what does it say about taking a loan? Where did I see that? It's actually the same thing. I think I have a different paper. But the same thing applies here, but probably slightly less numbers. This one is, I think, 0.9%, but I can't see my, can't see that page. But it's just less by a few cents. And that is if you take a loan in year 2 or year 1, between year 1 to year 11, year 10. After that, 0. So that answers the second way to access money from this account. You can take out money as a loan. You can also take out money if you get a terminal illness. In case of a terminal illness, terminal means the doctor says you can't live for the next 20 years, the next 12 months. Okay. Unfortunately, you can't live for the next 12 months. And that's what the doctor said. Do some people live longer? Yes. But as long as the doctor says, oh, from what we see here, you cannot live for the next 12 months, the company is actually going to pay you up to 300,000 terminal illness. So for a terminal illness for this person, if they get a terminal illness anytime between when they open the account until 2102, that's 121 years. Anytime they get a terminal illness, insurance will pay up to 300,000. That's how they can access money through a terminal illness. They can also access money through a critical illness. What do we mean by critical? Critical means that you're very sick, but you're not about to die. Simple. They think you're very sick. They still think you still have a lot of time on you. So that's why they say, if the insured becomes critically ill, while the policy and rider are in effect, you may elect to receive an accelerated death benefit payment subject to the provisions of the policy and this rider and the following conditions. Meaning, in case you still have this account and you get a critical illness at that point, okay, you're going to accelerate the death benefit. Whatever you have in the death benefit is what you're going to accelerate. Under what conditions? The insured must be certified by a physician as being a critically ill individual within 12 months of the accelerated death benefit request. The policy and rider must be in effect at that point. The face amount of the policy at the time the accelerated death benefit request is received must be at least 25,000. We must receive a written consent of all irrevocable beneficiaries if you have any, and all assignees if you have any. Okay. And accelerated death benefit is what? Is a portion of the policy death benefit paid prior to the death of the insured due to the insured's critical illness. So the payment of an accelerated death benefit reduces the face amount and values of the policy and any affected riders and endorsements, and the death benefit payable to the beneficiary upon death. What does this mean? This literally means that if you had a policy, this policy, and let's say you get a critical illness at this age, and the company gives you money, it's automatically going to affect, obviously, it's going to affect the death benefit because you're accelerating the death benefit at that point. Okay. Now, what do I want to show you? So you're accelerating money in case of a critical illness. And what are the critical illnesses? When do they say this person is critically ill? Is it this normal? If you're just sick, like you feel like you're very sick, you feel like you can't go to work, and you feel like you want to accelerate your death benefit. No, it doesn't work like that. The doctor has to say you cannot access money at that point. Rather, you cannot work. You're critically ill. You're diagnosed by the physician with one or more of the following health conditions, or you underwent one of or more of the following medical procedures. Number one is a heart attack. The death of a portion of the heart muscle resulting from inadequate blood supply to the relevant area. Heart attack must have been severe enough to require an inpatient hospital stay. What is going to happen? The company is going to pay. Your insurance policy is going to pay. So the diagnosis of heart attack must be based on the presence of any of the following: chest pain, associated new EKG changes which supported the diagnosis, or elevation of cardiac enzymes. That's heart attack. So in case you have this policy running and they said, oh, by the way, in case you get a critical illness, anytime you get it, let your family call us. We are going to give you up to 270,000. Why? Because this person applied for 300,000 and they are going to pay up to 90% of whatever they applied for. So that's what they're saying. In case you get a stroke, okay? If you get a stroke, which doesn't include ischemic events to the brain, then you're eligible to accelerate your death benefit. In case you get cancer, a disease manifested by the presence of one or more malignant tumors and characterized by the uncontrolled growth and spread of malignant cells and the invasion of normal tissue, which doesn't include any skin cancer except invasive malignant melanoma into the dermis, pre-malignant lesions, and carcinoma. I don't know whatever it means. It doesn't include it. End stage renal failure. When you get to that point and you have this account, the insurance company is going to pay. Major organ transplant. If the recipient by transplant of any of the following organs or tissues, heart, lungs, liver, kidney, pancreas, or bone marrow transplantation, means the replacement of the recipient's malfunctioning organ or tissue with an organ or tissue from a donor suitable, the company is actually going to pay. Blindness, permanent and uncontrollable and uncorrectable loss of sight in both eyes. Blindness must be confirmed by that physician, okay? And the corrected visual acuity must be worse than 20 out of 200 in both eyes. The company is going to pay. Paralysis, complete and permanent loss of use of 2 or more limbs through neurological injury producing paralysis resulting from trauma, polio, multiple sclerosis, or whatever that is. The paralysis must be confirmed to have been present by a physician or for a continuous period of at least 180 days from the time the paralysis begins. Okay? So when you get to that point and you lose 2 or more of your limbs, the company is going to pay. AIDS. Yes, AIDS. Is present when an individual infected with the human immunodeficiency virus meets criteria for acquired immunodeficiency syndromes as defined by the United States Center for Disease Control. The company is actually going to pay you. Yeah. If you acquire, now this doesn't mean you go and acquire AIDS, okay? Because you have a policy, you say, you know what, I want to use my policy. Let me go get AIDS. No, it doesn't mean that. But guess what? You get to that point and you have this policy, you're actually going to accelerate your death benefit. Aplastic anemia, a diagnosis of a chronic persistent bone marrow failure, confirmed by biopsy, which results in anemia. The company is going to pay. First coronary angioplasty, first ever balloon angioplasty or other forms of catheter-based percutaneous transluminal coronary artery therapy, whatever it means, the company is going to pay. First coronary artery bypass, I know this because I have a foundation with kids with heart complications. Okay? So the use of a non-coronary blood vessel to surgically bypass obstructions in a native coronary arteries. Procedure must be made by a physician certified. And guess what? The insurance company is going to pay. Motor neuron disease, a definite diagnosis of one of the following conditions: primary lateral sclerosis, progressive muscular amyotrophic lateral sclerosis. Whatever that means, if you get it, the company is going to pay you. You're going to accelerate the death benefit. Central nervous disease. That's the disease of the central nervous system, brain or spinal cord or whatever. If you get that, Huntington's chorea, Alzheimer's, Parkinson's disease, the company is going to pay. So, election percentage means a percentage of the available death benefit selected by you. in accordance with the maximum acceleration death benefit. So, who gets the money? Immediate family member, one of the following members of your or the insured's family, which is spouse or civil union partner, and anyone who is related to the individual or his or her spouse or civil union partner. Okay, this includes a parent or whoever would get that money on your behalf. You, the insured. So, all that I am showing you how the company is going to pay. How much do they pay? If you become critically ill while the policy and rider are in effect, you may request that acceleration between 2,500 and the maximum accelerated death benefit as outlined. The greater of 1,000 or 90% of the difference between the policy value, if any, and any loan balance. Okay. So the company is going to pay you up to 90% when you get a critical illness and you have this account in force. Okay. So you should not be worried about where am I going to get money? Oh my God, I am sick. I've gotten my parent is sick. They've gotten cancer. They've gotten whatever. You simply access your life insurance policy and the company is going to pay. If you get long-term illness, okay, you get long-term illness, the company is going to pay long-term care. Whenever you get sick, the company is going to pay up to 2% of whatever you applied, and that's per month. So in this case, this person who has 300,000 will get $6,000 per month. Per month, regardless of when they get sick. So even if they only paid for 1 year and they get sick with a chronic illness, they cannot perform 2 out of 6 activities of daily living. What is going to happen? The company is going to pay. Okay? The company is going to pay. And that's what we call long-term care. What happens? Remember, I am talking about accessing money. How to access money from your life insurance policy. And I talked about how you can access your money when you're still alive. Now I am talking about how you can access your money when you're ill. Okay? We've talked about terminal illness, critical illness, now long-term care. If you get sick with a long-term illness, what is going to happen? This is what is going to happen. To be eligible for monthly long-term benefits, the following conditions are satisfied. The insured is certified as chronically ill by a licensed health practitioner. A plan of care is prescribed. Proof of loss or documentation is provided, and there is a 90-day elimination period. So if you get sick chronically and you cannot perform activities of daily living, chronically means, what does chronic means? If you're chronically ill, it means a licensed professional has certified that you have a severe cognitive impairment that requires substantial supervision to protect you from threats to health and safety, or that you are unable to perform without substantial assistance from another individual, at least 2 or more of these activities of daily living for an expected period of at least 90 days due to loss of a functional capacity. Meaning, if you get to a point when you cannot perform 2 of these, that means you're chronically ill. And that would mean you're going to get monthly long-term care benefits. Activities of daily living is bathing, continence, dressing, eating, toileting, transferring. Okay? And there must be a written assessment of the insurer's physical and cognitive abilities by the doctor based on a face-to-face evaluation. Once they get that, guess what? I tell you what, this is what is going to happen. The company is actually going to send 2% of whatever you applied for per month. Okay? The company is going to get 2% of whatever you applied for per month. This is what I mean. You actually get, the minimum is 500 monthly benefit. Minimum $500 a month. That's the minimum. What's the maximum you can get? The lesser of 2% of the long-term care specified amount or the daily amount allowed under HIPAA multiplied by the number of days in the month. Okay? So, in other words, you get the lesser of 2%. So in this case, this person gets 2% of 300,000, which would be 6,000 per month. So if this person gets a long-term illness, and where I said long-term means you cannot perform 2 out of these. If you get to a point when you cannot perform 2 out of these for 90 days, the insurance company is going to give you 2% of whatever you applied for. Or if you have more, then they will look at the HIPAA. HIPAA. Okay? Maximum daily amount allowed by under HIPAA, which currently is around 400 something, because I know the monthly currently, maximum monthly is 12,600. 12,000. So this means if you have a long-term illness and you have a $1 million policy, okay, with a long-term care rider, the maximum you can get is $12,600 a month. Per month, as long as you go on a claim. The insurance company is going to pay you $12,600 per month if you have $1 million. That's the maximum for the HIPAA, But since in this example that I've been showing you, the person actually has 300,000. Okay, they applied for 300,000. Then they'll get 2%, which is $6,000 per month. Until when? They get $6,000 per month until whatever they applied for is exhausted. But guess what? In this example that I was showing you, now where's the page? In this example that I've been showing you here, this one, they are saying you have long-term care increasing. Okay? Increasing means you get the 2%, which would be 6,000 in this case, but it is increasing. So let's say you get to this point when you are actually 67. So you are accelerating what? 423,000, not 300,000. Okay? But you're getting 2% of 300,000, which is 6,000, until when this money is done. But now, what happens when you get, maybe you die before? Maybe you die before. What happens to the rest of the money? Here. What if I never receive long-term care benefits? No worries. Your beneficiaries will receive the full death benefit minus any outstanding loans if you have any. What if I receive some long-term care benefits? No problem. Your beneficiaries will receive the death benefit minus whatever you ate, whatever you used. Also, while receiving benefits, the long-term care rider charges will be waived. Okay? Other policy charges will continue to be assessed, but the long-term care charges are waived. So in other words, when you get to a claim, you actually are not paying for the long-term care charge. The policy will not lapse, and you're not required to pay the minimum no-lapse premium. So long-term care rider charges will not be waived if international coverage benefits are being paid. By the way, you can actually access this long-term care. You can still be paid this long-term care even when you're not here. But what they are saying is the charges will not be waived if you're receiving the long-term care outside the United States. So, in other words, if I got back to Kampala and I want to, to get my long-term care, no problem. I still get my check. Okay? So, that's another way of accessing my life insurance money. And then the last way to access your life insurance money is when you die. Now, this is what is common when it comes to life insurance. Most common. Most common. Most people know that when you have a life insurance, you die, the beneficiaries use the money. That's the most common one. Okay? But guess what? You have 3 different ways of accessing your money from a life insurance policy. But it depends on the type of insurance that you have. It depends on the type of insurance that you have. Okay? So, the death benefit, you can also access money from your death. Now you're not accessing. So this one is you. These 2, it is you using the money. You. This one is your beneficiary. Beneficiary, your kids, your wife or husband, okay, your parents, whoever you named as your beneficiary is using this money in this last one. But the first 2, it is actually you using this money. You only have to understand. And the biggest reason why people only think insurance is about death is because they don't call me. They don't know. Okay? How do I access the death benefit? No problem. What do you need? When you die, whoever you named or your family will have to call the insurance company and tell them that you passed. Because if they don't call, how will the insurance company know that you actually passed? The company cannot know. So somebody has to call and say, hey, by the way, Michael Kakande had an insurance policy with you guys. And this is the policy number. Can we get access to that money? Now, the problem is, how does the beneficiary know that you actually had a policy? Because there are many people who get insurance and no one knows. Why? Because they fear. They fear somebody will kill them to get the insurance money. They fear. Now, how do you get the beneficiary know that you actually had a life insurance policy without telling them? That's a big topic for another day. Again, if you're on TikTok, you can simply give me a call. Or you wait for another day when I'm talking about that. I'm not sure if you'll be live that day. If not, you give me a call. I'll write my number here. 781-363-5258. You can give me a call. Nevertheless, I'll talk about how do you access money how does your family access the money when you're now dead? They have different ways of accessing that money. They can actually get a lump sum, meaning when the death benefit is payable, we will pay it in a lump sum unless a settlement option is elected. What does this mean? If you die and you didn't elect any way that you want your people to get the money, what is going to happen? The company will pay them a lump sum. The company will imagine that you wanted them to get the money in lump sum. But you can also have different settlement options. So during your lifetime, you, the insured, you may request that we pay the death benefit under one of the following settlements. We also use any other method of payment that is agreeable to you and us. After the insured is dead, the beneficiary may elect to receive such beneficiary's share of the death benefit under a settlement option. However, you may provide that the beneficiary will not be permitted to change the settlement option you have selected. If a settlement option is requested, we'll send you a written notice which will state the terms and conditions. So, if something happens to you, your family can get an annuity. What is an annuity? That's also a day that I will use to talk about annuity in details. But the company will use the benefit as a single premium to buy an annuity. The annuity may be payable to one or two payees. It may be payable for a guaranteed period or for life, with or without a guaranteed period, as long as we agree to it. So you, the beneficiary, or rather the insured, can say or can elect that if I die, I want you, the company, to use to, instead of giving my family money, I want you to buy an annuity. In other words, I want you to reinvest the money into an annuity. The annuity payment will not be less than what our newly issued immediate annuity contracts with the same features are then paying. So whatever it will be paying, that's what they will be paying. So in other words, you have $1 million, okay? You have $1 million and you say, you know what? Instead of, if I die, my $1 million, don't give it to my kids. Please buy an annuity. And it could be an immediate annuity, or it could be a deferred annuity. So you can say, instead of paying them $1 million, buy an annuity. So in other words, you're saying reinvest that money into an annuity. So that can also happen if it's what you decide. Or they can withhold the benefit on deposit with them, and that money can keep earning an interest. Such interest will be at a rate declared by the company, and not less than an annual interest rate of 1%. So it will always be more than that. So you can say, okay, if I die, don't pay out all my money, keep it and make an interest. And then the payee may withdraw part or all of the benefit and earn the interest at any time. So let's say you say, okay, my family or my kids that I want to access this money are below 18, for example. You can say, okay, I want the company to keep the money until my kids are 18. What is going to happen? The company will actually give your money an interest. So by the time you want your kids to withdraw the money, they will withdraw whatever you had plus interest. Again, you are utilizing the death benefit, the money in all these ways. All the 3 ways you can access your money from a life insurance policy. Okay? From a life insurance policy, you can access the money you can withdraw or take out a loan if you're still alive. So in other words, with life insurance, you don't have to fast die, as most people think. You can use money when you get a terminal illness, a critical illness, or a long-term illness. That's when you're sick. This is when you're alive. This is when you're sick. This is when you die. So you can utilize money from a life insurance when you're alive, when you're sick, or when you die. It depends on what? A type of insurance that you have. I don't know if you have any questions, but that's what I wanted to talk about tonight. Again, thank you for being here, those of you on Zoom, and those of you on TikTok. I've spoken a lot of English already. I want to sign out, unless if you have any questions. Any questions? People on TikTok, David Silva, Tefra, or whoever. If you have any questions, please ask. People on Zoom, if you have any questions, please ask. If you don't have any questions, well, that's it. See you on another day. Keep safe. Okay. All right. Kamaliza. How are you doing, Yaron? Njala Kamaliza ompulira.
Mpulira ssebo. I'm fine. How are you?
Good. Oluzungu oluwulidde lwe njogedde.
Ane oluzungu oyogedde lungi naye lutegeerekeka.
lutegeerekeka.
Oluzungu lutegeerekeka.
Okay.
Teruliimu accent tutategeera buli kigambo tukitegeera nkitegedde bulungi kanjogere nga nze. Nvuze leeti naye thank you very much nkitegedde kyobadde otegeeza.
Wonderful. Ebintu bino twetaaga obitegeera gy'okoma obitegeera gy'okoma obyagala n'owulira ng'ogamba oh my god abasajja bano baakola ebintu byabwe.
Olaba nti baapulaninga bo tebabigwamu bugwi nga ffe. Amanyi ne bwali afudde emyaka emeka wajja kubeerawo ekitambula buli kimu kiringa bwe yagamba tekigenda kukyuka. Tojja baatuleka nnyo bano naye tujja basanga tujja gezaako.
Ekisinga obulungi kitwajja gye bali. Kati ekizibu kyokka kye tukola kwe kusigala nga tukola ng'ewaffe.
Tetujja kukkiriza kukola bwe tutyo.
Kitegeera.
Tuli babugumyeko kati tulina okukola ekiri different, you know?
Exactly.
Tetuyinza kujja wano ate ne tukola volongoto gwe twalimu